When you're making markets, like how do your systems know what to do? How much does it require? How much does it require, like a person behind a desk to turn some knobs, or like tell the system how to react, versus it just knows? Kobe, listen. I'm an idiot.
I'm listening. The
listeners are also idiots, so I have to
How
ask
does computer
questions.
know what to do?
Like how much manual massaging is required, like in management of
manual
daily
massaging.
You know what I'm asking, so I'll just shut up.
Yeah, well, I think there's like a spectrum of strategies, right? There's some that are highly automated, highly alpha driven. There's some that require more massaging and intervention. I guess it's like a good opportunity to clarify how how the building of these strategies at a very high level even works. And so generally you have an alpha building process where you're trying to build models that can predict the price on some time horizon, and say it's like 10 seconds, right? So you have all this archive data. You have these machine learning models, you spit a bunch of grid jobs out, and it's all these computations going on that should result in a predictive model that has, a decent chance of predicting what the price is going to be on that time horizon, right? You take that model, you plug it into a strategy, you figure out how to execute on that prediction, and then you scale that out across the world and participate as aggressively with as much size as is reasonably possible, right? And when you're running like a lot of strategies, you can't like just hand tune each one of those. And so there's a lot of quantitative processes that go into sizing, alpha building, and like all those kinds of things. But then, there's also like I was saying, the 3-3 stuff. I mean, there's things about the markets that the models just don't know about. And when you do know about those things, then, it's up to the traders, who kind of have the pulse of it to tweak the knobs and react appropriately. So
yeah. One of the things that happens is market's normal and the book gets pretty tight or whatever, and there's a decent amount of money on both sides. Kobe just is laughing at my stupidity. But then something...
Just hearing you explain how markets work, I love it. Like a very sophisticated answer, and then you're like, look, so there's some bids on one side.
So... an event comes along, and then like the order book just spreads out. It's like you guys disappear. You're the people disappearing off of the book. So is it a model that detects variations in activity and is just kind of algorithmically understanding that you don't know exactly what's happening in the market, but the market's doing something different, so you have to spread out in order to maintain profitability?
Yeah, it's a couple of things. So the price models that are used to make market making models, the liquidity models, are also similar to the ones that I kind of described. And so you have models that are trying to predict the price. And if you think the price is going to be very different from where it is right now, you don't want to be providing liquidity on the bid and the offer, right? You want to get out of the way because you think the price is not going to be there anymore, and it's going to be a bad trade for you. And so as vol goes up, as various factors into the model change, the model attempts to get out of the way, get up and not sit on adverse flow. Now that's different in situations where you have like dedicated liquidity providers who are just sitting there at all points in time trying to provide some liquidity, even in adverse events. And you're just and those folks are just sitting in there and taking the flow and taking the L because that's part of what they're doing, and they hope to make it back on the spread when it's better. And it's okay.
And how does that change when you get into DeFi markets and liquidity provision in on-chain stuff? Because it's significantly different structure than an order book.
Yeah, I mean, so if you go to like the AMM models, like the XYK stuff, there isn't really any getting out of the way, right? Like you just stick your money in, and that's about it. And so that's not really where any sophisticated trading participant has edge in providing liquidity. It's LP positions have a negative expected value if you believe that the assets are going to be uncorrelated, right? And so your kind of liquidity strategy has to be maybe more taking focused, or maybe you just take the L because you have some vested interest in making that thing liquid and usable. Or, if you have something like an EV3, then you move your orders around and you do things with it. But on Ethereum, like paying $100 to move a quote, like it's not going to work out.
UpOnly.